If we take a step back and we look at the market impact of the midterm elections, it's a widely held canard that divided government is positive for markets. Quantifiably, that is true. Normally, when you get divided government, the period of market return from November through end of year, divided government's about 4%. Undivided government's about 1.8%. So let's not get ahead of ourselves in terms of the quantum of that outperformance, but it is true. I think the danger here is that from a JP Morgan perspective, markets have fully priced in divided government already, in which case it's the next conversation that we have to have. And to the point of your question, the next conversation is now you have two political parties that know that no significant legislation will get out. The risk here is that you get political grandstanding on both sides. Both parties know that they can appeal to their base, and the other side must stop them. And so the escalatory spiral that you could see in the rhetoric coming out of the U.S. is something that I think we have to be concerned about, given that the positives of this election are largely already in the price based on JP Morgan numbers.
So when you say be concerned about, what action should we take? Because, you know, an escalatory spiral in this context could end somewhere very, very ugly.
It can. I think the precondition to that, however, is it's a lot of news without necessarily a lot of action, again, because both parties will hopefully stop each other from doing anything too extreme. And so I think it's understanding the impact that this news flow is having on share prices, but also understanding what the underlying reality is likely to be. Again, the overarching mantra for us going into 2023, bottoms-up fundamental analysis matters again. It is not just all about macro as it was in 2022.
I want to talk about the bottom-up fundamentalist analysis in a second. Let's just stick with the macro picture for a moment, because the movements that we're seeing economically in the U.S., just tell me how you're seeing that market move out, because so much of what we've been talking about in this past few days has been the midterms. Everyone's worried. Sure. But the underlying inflation problem, the underlying economic trajectory, the underlying market action that we've seen, how are you assessing that if we exclude the political factor? And
if I can maybe extend your question one layer further, which is ultimately this is a markets conversation, which it's not just about the reality, it's about what the market has already priced in of that reality. And that's actually a significantly more positive conversation. The markets have now priced in a terminal Fed funds rate of 5.25%. That's actually above JP Morgan expectations right now. The inflationary conversation is fully cognizant and fully priced into markets at this stage. And so the potential for us to start to look through this, I do think, is important. I think the critical number that we're focused on is the global industrial PMI right now is currently sitting at 49, which is a record low outside of recession. The numbers don't stay there for very long. Either you slip into recession, which is our base case expectation, or you start to bounce back. So the odds of the U.S. going into recession are extremely high. I don't think that that's something that we should be overly concerned about, however. That is a normal business cycle, and we can look through that.
All right. Well,